Howdy, y'all. Welcome to Liberty Call. Today is Friday, September 29, 2023. Hope everybody's having a fantastical day. I am Raymond Dahlman, your humble host here at the Liberty Call. And looks like the markets were kind of meh today. It's been a very rocky week as far as volatility, down days, up days. Today was kind of both. It started out in the morning, markets were up, then they went into the red, and then they finished off kind of mixed. So anyways, if it is your first time watching Liberty Call, I am glad you're here. Thank you very much. If you could do me one favor and one favor only, press the like button, maybe the subscribe button, the follow button, all the buttons, so you can watch us on a regular basis. Hit the notification bell so you know when I go live. All right, let's go ahead and get into the numbers for today. All right. Dow Jones finished the day off down 0.47%, 158 points, closed at 33,507. S&P 500 was down 0.23%, closed at 4289. NASDAQ up 0.14%, closed at 13,219. The VIX was up today 1.44%. It's at 1759. Canada down 0.25%. Brazil was up 0.65 and Mexico down 1.28. Hopping over to Europe, Germany was up 0.41, the UK up 0.08, so pretty much flat. France up 0.37, the Netherlands up 0.39. Spain flat, up 0.01, Italy up 0.28, Switzerland up 0.42, and Portugal up 0.63. Russian exchanges were mixed, the MOEX up 0.81, RTSI down 0.34. And the Asian markets, starting out with the Nikkei in Japan, was flat at up 0.03, Australia up 0.34, New Zealand up 0.86. In China, the Shanghai, looks like all the Chinese markets were closed for the 29th, so we'll skip over that. The Hang Seng was up 2.71%, and also the Taiwan weighted was closed. So, all righty. So, like I said, no, not quite as angry as a few days ago, but certainly not excellent by any stretch of the imagination. All righty, let's go ahead and bring up the charts for the week and see how they finished off. Starting out with the Dow Jones, looks like it's going to finish the week off down about 1.17%. The S&P 500, it's going to finish off down about 0.65. NASDAQ, pretty much break even, up 0.09. The Dow Transports, pretty flat. Looks like it's up 0.01. And the Dow Utilities, this one's going to be down for the week. Dow Utilities is down almost 6%, 5.9 to be more precise. So, not excellent. All right, well, let's go ahead and zoom out and take a look at the bigger trends and see how they're lining up. Let's go ahead and start at the beginning of last year where the downtrend began. Again, this is the Dow 30. We were in the downtrend most of last year, broke the downtrend in November, traded sideways late last year and most of this year, had a little bit of an uptrend in the hopes that the Fed was going to pause or cut rates or whatever people thought was going to happen. And we can see here in this upward trend or line of resistance, it kept bouncing off it as the months went by. Did break through on, what day was that? September 21st. And so if we zoom in a little closer, we can see this consolidation where the downtrend and then this uptrend meet. So based upon this, I would say it's kind of lining up. If we, kind of zoom over here, it's going to probably trend something like that and trend down. So, looking at the bigger picture, that's kind of where things are lining up now. We do have beginning of August is when this trend started. So we do have a couple months of data now behind us. And, looking at the momentum indicator, it went into the red about the same time as the crossover. So, longer term trend, and you can see here this on the momentum indicator where it crossed into the positive territory back in April. If we zoom out, again, we only had this dip into positive territory from March through mid-April. So that's where this little dip is. So other than that, from the time of late last year where we, bucked the trend and started heading in a more positive direction, we've only had a very short period, about a month and a half, where the momentum indicator was in the red down here on this chart. So anyways, let's go ahead and look at the S&P 500. It's going to look very, very similar. Starting at the beginning of last year, broke the downtrend in January of 23, had been on this uptrend for quite a bit, as we can see. And it looks like we broke the uptrend here on, what day was that? The 20th of September. So I'd like to see a little, since we did kind of bust through the downtrend here, I'd like to see a little bit more as far as the S&P, a little more data as far as this downward trend, but looks like it's kind of lining up. And then same thing with the NASDAQ composite. Broke the uptrend on, what day was that? September 18th. So they all look fairly similar. They're all going to be within a few days of each other because a lot of these hold the same securities. All right. Well, that's everything there. Let's go ahead and get to the economic data that came out this week. Starting out with jobless claims, we came in at 204,000. Forecast was 215. Last week's number was 202. Continuing claims came in at 1.67 million. Forecast was 1.675 million, so a little under forecast. Previous week was 1.658 million. Consumer confidence this week, they came in at 103. Forecast was 105. Last month's number was a 108. So it looks like confidence is starting to wane a little bit. New home sales came in at 675,000 against a forecast of 700,000. Last month's number was 739 annualized. The month-over-month number shows an 8.7% contraction, and last month's number grew by 8%. So it's, again, looking down here at this this chart, you can see we kind of go, up, 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 down, up, 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 down, up, up. So it's kind of back and forth. All right, durable goods orders month-over-month grew at 0.2%. Forecast was a 0.5% contraction, so beat the forecast by a lot. Gross domestic product was revised, or came in at 2.1%. Against the 2.1% forecast. And we can see we came in at the beginning for Q2. The initial number was a 2.4% growth. It was revised down in August to 2.1. And it looks like they're sticking with that number for now. So personal income month over month grew at 0.4%, right on forecast. Last month's number was a 0.2% growth. And expenses grew at 0.4%, same as the forecast. And last month's number was a 0.9%. So it looks like expenses did contract a little bit. All right, well, that's all the economic data for the week. Let's go ahead and turn our attention to the market recap. S&P 500 turns negative as government shutdowns loom. Oof, everybody's freaking out about that. All right, the S&P 500 turned negative amid concerns about a looming government shutdown after the House of Representatives failed to pass a short-term spending measure. The measure aimed to keep the government open until October 31st, Halloween, but its failure raised fears of a shutdown on October 1st, potentially impacting fourth quarter economic growth. I don't know how much economic growth the government really does. Yes, that spending does get included in GDP, but most of it is just stealing from me and spending it on defense contractors. Morgan Stanley notes that a government shutdown is nearly consensual in Washington and the duration remains uncertain, posing a risk of negative fourth quarter GDP growth. Despite this, inflation concerns eased as the core personal consumption expenditures price index, the Fed's preferred inflation metric, slowed to 0.1% from 0.2%. This shift sparked optimism that the Fed's fight against inflation may be making progress. The disinflation trend in core inflation suggests that the Fed is nearing or at its terminal level, according to Stifel. Big tech stocks traded mixed, with Alphabet and Meta platforms leading to the downside, despite the retreat in Treasury yields. Rising Treasury yields have recently impacted big tech, but the mixed performance indicates ongoing market uncertainty. The United Auto Workers Union expanded strikes at General Motors and Ford, but spared Stellantis, which they had raised up their game last week against them, citing progress in recent talks. They said the same thing about Ford like a week and a half ago. Stellantis made significant progress in negotiations related to various factors, leading to a more positive relationship with the UAW. Ford, however, is back on the bad side of the UAW, according to Wedbush, as expanded strikes target Ford's assembly plant in Illinois and GM's in Lansing. Nike reported blowout fiscal quarter earnings, offsetting a revenue miss and sending the stock over 7% higher. Nike's optimistic forecast for fiscal Q2 revenue expected to be slightly up from the same period last year boosted investor sentiment. UBS noted that investors are likely becoming less concerned about macro factors in China and more excited about Nike's stabilizing top-line trajectory and accelerating margin expansion. All right, so some good news, some bad news, but it's not terrible. Moving on over to an article from Zero Hedge. It's titled Soft Landing, Hope by the Fed is likely optimistic. This was written by Lance Roberts via realinvestmentadvice.com. Let's see what he had to say. All right. The Federal Reserve's optimism about achieving a soft landing for the economy may be overly optimistic. I totally agree. According to Bull Bear Report, which highlights the Fed's historically inaccurate economic growth projections, despite the Fed's initial projection of nearly 3% growth in 22, it's been revised down to 2.2%, signaling a continuous trend of overly optimistic forecasts. And we covered that yesterday or the day before, where they've revised down all the Q1 numbers for 2021 and 22. The report discusses the Fed's strategy of keeping one rate hike on the table to prevent immediate speculation about rate cuts. This tactic is designed to maintain long-term interest rates and avoid a premature boost to the economy. It notes that since October of the previous year, the market has been anticipating rate cuts and increasing asset prices, which, if realized, could boost consumer confidence and potentially maintain inflationary pressures. Soft landing hopes are based on easing inflation and cooling labor markets, but the report argues that such soft landings are historically elusive. The Fed's previous forecasts for economic contraction in 22 were proven wrong as the economy displayed unexpected resilience. However, with the restart of the student loan payments, UAW strikes, and high prices affecting consumer savings, the support for economic growth is fading. The report emphasizes leading indicators such as the leading economic index, which has shown a negative reading for 17 consecutive months, signaling a potential recession. The inversion of multiple yield curves also suggests the risk of a recession, with 90% of the yield spreads monitored currently inverted. The report concludes that while the Fed remains focused on lagging economic data, the yield curve is sending a warning message that should not be ignored. I've been saying it for a while. And history has not been favorable to those who dismiss it. So, yeah, not good. Be prepared, folks. Build your sandbag fortress and make sure you got all your assets in the right places, because it could get bumpy. All right. Excuse me. Gosh. Whew, salty. All right, one last article here. It comes from the Mises Wire. It's titled Assessing the BRICS Expansion, Debunking Expectations. This comes from Antonio Graceffo, is the author. All right, let's see what he had to say. All right, the recent expansion of the BRICS, Brazil, Russia, India, China group includes 6 new countries: Saudi Arabia, the United Arab Emirates, Iran, Egypt, Ethiopia, and Argentina, and has been hailed as historic by some leaders, but the feasibility of the expanded group goals is in question. While China's Xi Jinping sees the move as injecting new vitality into BRICS cooperation, various challenges, conflicts, and diverging interests among members and new countries cast doubt on the success of the expanded alliance. The lack of shared interests among the new members is a significant hurdle. Existing conflicts such as Russia's involvement in Ukraine, civil unrest in Ethiopia, and historical tensions between Iran and Saudi Arabia could impede meaningful cooperation. India's border dispute with China adds another layer of complexity as it strengthens defense ties with the US, Australia, and Japan. De-dollarization, a goal discussed within the BRICS, face challenges. The U.S. dollar's widespread use in trade as a peg for many oil-producing nations and its preference as a reserve currency complicate efforts to replace it. The creation of a BRICS currency was not a focus of the recent summit, indicating the complexity of such a move. Institutional limitations are evident, with the new development bank being the only existing BRICS institution. The NDB has primarily operated in U.S. dollars with low convertibility and high instability of member currencies. Discussions at the summit prioritized stabilizing member currencies over de-dollarization. The diverse economic conditions within BRICS, ranging from India's optimistic outlook to Argentina's High inflation pose challenges to cohesive economic policies. The larger economies, China, India, and Russia, are also the top military powers, with China and Russia exerting more global influence in politics and diplomacy. Controlling minerals and oil, with the inclusion of Saudi Arabia, the largest crude oil exporter, could potentially influence global oil production. However, the lack of coordination among mineral producers and opposition to trade barriers limit the group's ability to control commodity prices. The expansion of BRICS, while ambitious, faces considerable obstacles that may hinder the realization of its goals. The risk of replacing U.S. hegemony with Chinese hegemony is also a concern, raising questions about the true motives behind the alliance's expansion. I mean, I know some of the articles I've already covered have been more glowingly talking about the BRICS and their plans, and what happens if they do create a currency that's backed by gold. Could be problems for the dollar. This one poo-poos on that a little bit more, so I like to try and give both sides of the argument. Yes, all those countries do not have the same objectives or goals, and some of them have conflicts with each other. But how's that really different than the U.S. being the 800-pound gorilla in the corner, and they're using our money, and I would venture a guess and say at least 50% of the global nations cannot stand the United States, either because of how they bully them with the military or bully them with sanctions, or other, come in and offer them lending terms to, help their economy or their expansion of, municipality services and things like that, usually at high interest rates. And then when they can't pay it back, oh, well, hey, you happen to have oil or gold or lithium under your soil. Well, we'll just go ahead and take that. So anyways, that's how big government works in this world. Alrighty, well, that's everything I had for today and for the week. I hope everyone has a fantastical weekend. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. And again, like I said, I hope you have a wonderful weekend, and I'll talk to you next time. Adios.